morning, dear students. A warm welcome to a new session on financial market, and this is the second video. Now, let me explain you the types of financial markets. So, financial markets are broadly put into two categories. One is the money market, two is the capital market. And in this video, our focus is going to be on the money market. Now, let me explain you the money market. So, money market is a market for short-term funds, and it deals in monetary assets whose maturity period is up to 1 year. Examples would be Treasury Bills, commercial papers, call money, certificate of deposits. These are all important financial instruments. In call money market, RBI, commercial banks, mutual funds, these are the main participants in the money market. Now let me list down the money market instruments for you. One is called as call money. The second is called as treasury bill. The third one is called as commercial paper. The fourth is called as certificate of deposit. The fifth is called as commercial bill. You can call it bill of exchange or trade bill. Now let me explain you the features of money market. So, money market instruments are very close substitutes for money. They are unsecured and they are short-term debt securities. Also, the money market instruments are less risky, and the greatest advantage is that these instruments are highly liquid. Now let me explain the call money in detail. So as we know, call money is a short-term finance used for interbank transactions. These loans are repayable on demand at the option of either the lender or the borrower. Call money is a short-term finance, and this is mainly used for interbank transactions. Call money is a method by which banks borrow from each other to be able to maintain the cash reserve ratio. And the third very important point is it is repayable on demand with a maturity period of 1 day to 15 days. It is a market for extremely short period loans. The day-to-day surplus funds, mostly of banks, are usually traded as call money. The interest rate paid for call money loans is also known as the call rate. Now let us look into the second money market instrument, and this is called as treasury bills. Now these bills are directly issued by Reserve Bank of India on behalf of the Government of India to meet its short-term requirements of funds. Dear students, these are short-term credit instruments, and this is for a period of less than 1 year. These are sold to the banks and the public. Treasury bills are negotiable instruments and they are freely transferable. Treasury bills are highly liquid because it has an assured yield and the risk is minimum or negligible. This can be issued with a minimum amount of 25,000 and its multiples thereof. Treasury bills are also known as zero coupon bonds because they are issued at a price lower than their face value, however, they are repaid at par. Now let me talk about commercial papers. These are very popular. Commercial paper is a short-term, unsecured money market instrument. This is issued as a promissory note, not by big business firms, having excellent credit ratings. And these are for a period of 1 to 15 days. Commercial paper is a short-term, unsecured money market instrument issued as a promissory note by big firms who have excellent credit ratings. It is a short-term source of fund for mainly seasonal and working capital requirements. It can also be used to meet the flotation cost of new issue of securities. Example, brokerage, commission. This is also known as bridge financing. Now let us talk about certificate of deposits. So, a certificate of deposit is an unsecured and negotiable money market instrument, and this is issued by commercial banks or selected financial institutions against the money that is deposited. Now the period of these deposits usually range between 91 days to 1 year. Now you would ask, when is this suitable? This is suitable when the deposit growth of the bank is low but the demand for credit is high. Now you can see in the picture an example of certificate of deposit. Now let me come down to commercial bills, which are also called as bills of exchange, which are also called as trade bills. Now let me elaborate. So this is a short-term negotiable instrument, and this is used to finance the credit sales of the firm. Trade bill is issued by the seller, who is also called as drawer, on the buyer, who is also called as drawee, for the value of goods delivered by him. These bills are of 30 days, 60 days or 90 days maturity period. Thank you, dear students. I hope this video is going to be useful for you in understanding the money market.